Principles and Practice of Auditing. 5th Semester. Syllabus. Module 2, Risk Assessment and Internal Control. Introduction, Audit Risk Assessment of Risk. Internal Control, Meaning and Objectives. Internal check, meaning, objectives and fundamental principles. Internal check with regards to wage payment, cash sales, and cash purchases. Introduction to Risk Assessment and Internal Control. Risk assessment is an important aspect of auditing, involves the evaluation of potential risks that may impact the financial statement's reliability. In the context of auditing, risk refers to the possibility of misstatements or errors in financial reporting. Internal control is a system designed to safeguard assets, ensure accuracy, correctness in financial reporting, and promote operational efficiency. The primary objectives include preventing and detecting fraud, errors, and ensuring compliance with laws and regulations. Audit risk, 2 marks and 5 marks. Meaning of audit risk. Audit risk is the risk that auditors may express an inappropriate opinion on financial statements. It involves the chance that the audit procedures fail to detect material misstatements, whether due to fraud or error. Components of audit risk. 1. Inherent risk. 2. Control risk. 3. Detection risk. Explanation. 1. Inherent risk. This is the risk associated with the nature of the business, such as complexity, openness to fraud, or changes in the industry. Inherent risk is independent of internal controls. 2. Control risk. This is the risk that internal controls fail to prevent or detect material misstatements. It depends on the effectiveness of the internal control system. 3. Detection risk. This is the risk that audit procedures will not identify a material misstatement. It is within the auditor's control and can be influenced by the nature, timing, and extent of audit procedures. Conclusion. These components collectively determine the overall audit risk and guide auditors in planning and executing their audit procedures effectively. Assessment of risk. Meaning of assessment of risk. Risk assessment is a structured process that involves identifying, analyzing, and evaluating potential risks within an organization. In the context of audit and internal control, risk assessment helps to understand the factors that could impact the reliability of financial reporting and helps to develop strategies to manage these risks effectively. Process for assessment of risk. 1. Understanding the entity and its environment. 2. Identifying significant accounts and disclosures. 3. Assessing inherent risk. 4. Assessing control risk. 5. Determining detection risk. 6. Developing the audit plan. Explanation. 1. Understanding the entity and its environment. Auditors gain an understanding of the entity's operations, industry, regulatory environment, and internal control systems. This helps identify inherent risks, error in financial statements, and assess the effectiveness of internal controls. 2. Identifying significant accounts and disclosures. Auditors identify key financial statement accounts and disclosures that are material to the financial statements. These include accounts with high balances, high transaction volumes. 3. Assessing inherent risk. Auditors evaluate the inherent risk associated with each significant account. Factors such as industry dynamics, complexity of transactions, openness to fraud, and changes in regulations are considered. 4. Assessing control risk. Auditors assess the effectiveness of internal controls in mitigating risks of material misstatement. They may perform tests of controls to determine their operating effectiveness. 5. Determining detection risk. Based on the assessed inherent and control risks, auditors determine the level of detection risk they are willing to accept. Detection risk is managed through the nature, timing, and extent of audit procedures. 6. Developing the audit plan. The assessment of risk guides auditors in developing an audit plan to address the identified risks effectively. Of assessment of risk. Meaning of assessment of risk. Risk assessment is a structured process that involves identifying, analyzing, and evaluating potential risks within an organization. In the context of audit and internal control, risk assessment helps to understand the factors that could impact the reliability of financial reporting and helps to develop strategies to manage these risks effectively. KV. Importance of assessment of risk. 1. Enhanced decision-making. 2. Improved resource allocation. 3. Strategic planning. 4. Financial stability. 5. Fraud prevention. 6. Continuous improvement. Explanation. ANNATH ready. 1. Enhanced decision-making. By identifying and assessing risks, organizations and auditors can make informed decisions. 2. Improved resource allocation. Risk assessment helps to prioritize efforts and allocate resources where they are most needed. This ensures that resources are used efficiently to address important risks. 3. Strategic planning. Organizations can put their strategies with identified risks. This proactive approach enhances the likelihood of achieving strategic objectives. 4. Financial stability. In the context of audit, assessing financial risks helps to ensure the accuracy and reliability of financial statements. This contributes to maintaining financial stability and trust among stakeholders. 5. Fraud prevention. Risk assessment helps in recognizing fraud. By understanding where fraud risks exist, organizations can implement controls to prevent and detect fraudulent activities. 6. Continuous improvement. Regular risk assessment allows organizations to adapt to changing circumstances. It provides a basis for continuous improvement. Internal control. Meaning of internal control. Internal control refers to the system of policies, procedures, and practices implemented within an organization to ensure that its operations are carried out effectively and efficiently, and financial information is reliable, and compliance with laws and regulations is maintained. Objectives of internal control. 1. Safeguarding assets. 2. Ensuring accuracy in financial reporting. 3. Preventing and detecting fraud. 4. Enhancing accountability. 5. Promoting operational efficiency. Explanation. 1. Safeguarding assets. Internal control helps to protect an organization's assets from theft, misuse, or damage. This includes physical assets like inventory and equipment, as well as intangible assets like intellectual property, patents and copyrights. 2. Ensuring accuracy in financial reporting. Internal control systems are designed to provide reasonable assurance that financial statements are accurate and reliable. This involves preventing and detecting material misstatements in financial information. 3. Preventing and detecting fraud. Internal controls play an important role in preventing and detecting fraudulent activities within an organization. 4. Enhancing accountability. Internal controls helps to establish clear lines of responsibility and accountability within an organization. This ensures that individuals are held responsible for their assigned tasks and activities. 5. Promoting operational efficiency. Internal controls are implemented to enhance the efficiency and effectiveness of an organization's operations. This includes optimizing processes to achieve organizational goals and objectives. Internal check. Meaning of internal check. Internal check refers to the arrangement of duties and responsibilities within an organization in a way that no single individual has complete control over a transaction from start to completion. In other words, the internal check goal is to create a system of checks and balances where different employees verify each other's work, reducing the risk of errors or fraud. This helps to ensure the accuracy and reliability in financial and operational processes. Objectives of internal control. 1. Preventing errors. 2. Detecting fraud. 3. Ensuring accuracy. 4. Compliance with policies. 5. Minimizing the risk of illegal. 6. Enhancing accountability. Explanation. 1. Preventing errors. Internal check systems aim to prevent errors by having multiple individuals involved in different stages of a process. This helps catch mistakes early in the workflow. 2. Detecting fraud. By dividing responsibilities and introducing cross-verification, internal check systems are designed to detect and analyze fraudulent activities. 3. Ensuring accuracy. Internal check contributes to the accuracy of financial and operational data by having independent reviews at various stages. This reduces the likelihood of inaccuracies going unnoticed. 4. Compliance with policies. Internal check systems helps to ensure that employees adhere to organizational policies and procedures. 5. Minimizing the risk of illegal. By having multiple individuals involved in different aspects of a process, internal check systems reduce the risk of illegal. 6. Enhancing accountability. Internal check systems establish clear lines of responsibility and accountability. Employees are accountable for their specific roles. Fundamental principles of internal check. 1. Division of work. 2. Rotation of duties. 3. Dual control or verification. 4. Segregation of functions. 5. Independent checking. 6. Physical verification of assets. 7. Documentation and record keeping. 8. Authorization procedures. 9. Supervision and monitoring. 10. Employee training and awareness. 11. Technology controls. 12. Clear communication channels. KV. Explanation. 1. Division of work. Divide tasks and responsibilities among different individuals to ensure that no single person has complete control over a transaction from start to finish. This helps prevent errors and fraud by introducing independent verification points. 2. Rotation of duties. Rotate employees across different roles periodically to prevent and reduce the risk of fraudulent activities. This practice also ensures that individuals gain a broader understanding of the organization's operations. 3. Dual control or verification. Introduce a system of dual control where two or more individuals independently verify and authorize transactions. This ensures that errors are more likely to be identified through cross-checks. 4. Segregation of functions. Separate key functions such as authorization, recording, and custody of assets. This segregation reduces the risk of a single individual. 5. Independent checking. Establish independent checks on financial and operational activities. This could involve periodic audits, reviews, or inspections conducted by individuals who are not directly involved in the day-to-day execution of tasks. 6. Physical verification of assets. Regularly verify and recheck physical assets with recorded amounts in the financial records. This helps ensure that assets are properly safeguarded and accurately reflected in the organization's accounts. 7. Documentation and record keeping. Maintain detailed and accurate records for all transactions and activities. Proper documentation serves as evidence of the organization's financial and operational history. 8. Authorization procedures. Clearly define and implement authorization procedures for various transactions. This ensures that only authorized personnel have the ability to initiate and approve specific actions, minimizing the risk of unauthorized activities. 9. Supervision and monitoring. Establish a system of supervision and monitoring to oversee the implementation of internal check procedures. Regular oversight ensures that employees adhere to established controls and procedures. 10. Employee training and awareness. Provide ongoing training and awareness programs to employees about the importance of internal check principles. Educated and informed staff are more likely to understand and actively participate in maintaining effective internal controls. 11. Technology controls. Implement technological controls, such as access restrictions and audit trails, to enhance the effectiveness of internal check mechanisms in a digital environment. This is particularly important in safeguarding electronic data and transactions. 12. Clear communication channels. Establish clear communication channels within the organization for reporting concerns or observations related to internal check. Open lines of communication foster a culture of transparency and encourage employees to raise issues without fear. Internal check with regards to wage payment. 1. Segregation of duties. 2. Verification of time and attendance. 3. Dual authorization. 4. Regular payroll re-check. 5. Auditing payroll procedures. Explanation. 1. Segregation of duties. Separate the responsibilities for processing payroll, authorizing payments, and distributing funds. This ensures that no single individual has control over the entire payroll process, reducing the risk of errors or fraudulent activities. 2. Verification of time and attendance. Implement a system to independently verify time and attendance records. This could involve supervisors of a designated department confirming the accuracy of worked hours before payroll processing. 3. Dual authorization. Require dual authorization for payroll distributions, where more than one person is involved in approving and authorizing wage payments. This adds an extra layer of control and reduces the risk of unauthorized payments. 4. Regular payroll recheck. Periodically recheck payroll records with other relevant documents, such as attendance logs and employee contracts. This recheck helps to identify difference and ensures that wage payments put with established policies. 5. Auditing payroll procedures. Conduct regular internal audits of the payroll process to verify compliance with established policies and procedures. Audits can identify weaknesses in the system and helps to address issues before they escalate. Conclusion. These internal check measures helps to enhance the accuracy, transparency, and reliability of wage payment processes within an organization. Internal check with regards to cash sales. 1. Segregation of duties. 2. Cash register controls. 3. Use of pre-numbered invoices, receipts. 4. Surprise cash counts. 5. Periodic re-check. Explanation. 1. Segregation of duties. Divide responsibilities related to cash sales among different individuals. For example, separate the functions of processing sales, handling cash, and making cash transactions to prevent any single person from having control over the entire cash sales process. 2. Cash register controls. Implement controls on cash registers, such as unique cashier IDs and restricted access. Regularly recheck the cash register totals with actual cash on hand to identify difference promptly. 3. Use of pre-numbered invoices, receipts. Employ pre-numbered invoices or receipts for cash sales. This helps in tracking and re-checking transactions, making it easier to identify any missing or duplicated transactions during internal checks. 4. Surprise cash counts. Conduct surprise cash counts at various intervals. This involves counting the cash in the cash register without advance notice. Difference between the counted amount and recorded sales can be investigated promptly. 5. Periodic recheck. Recheck cash sales records with other relevant documents, such as sales invoices and bank deposits, on a regular basis. This ensures that all cash transactions are accurately recorded and accounted for. Conclusion. These internal check measures help organizations manage the risks associated with cash sales, promoting accuracy, transparency, and accountability in the handling of cash transactions. Internal check with regards to cash purchases. 1. Segregation of duties. 2. Documented approval process. 3. Supplier invoices and receipts. 4. Recheck with bank statements. 5. Random inspection of purchase records. Explanation. 1. Segregation of duties. Separate the responsibilities for initiating, authorizing, and recording cash purchases. This ensures that multiple individuals are involved in the various process, reduces the risk of errors or fraudulent activities. 2. Documented approval process. Implement a documented approval process for cash purchases. Require proper authorization before making cash purchases, and maintain records of approvals to ensure accountability. 3. Supplier invoices and receipts. Match supplier invoices and receipts with the recorded cash purchases. This helps verify the accuracy of transactions and ensures that the organization receives the goods or services it pays for. 4. Check with bank statements. Regularly recheck cash purchase records with bank statements. This rechecking helps to identify any difference between recorded transactions and actual bank withdrawals, enhancing accuracy in financial reporting. 5. Random inspection of purchase records. Conduct random inspections of cash purchase records to ensure whether it complies with internal policies and procedures. This periodic review helps to identify any irregular or deviations from established controls. Conclusion. By implementing these internal check measures, organizations can strengthen control over cash purchase processes, reduce risks, and improve the accuracy and reliability of financial records.